Hi guys, I'm Phil Town from Rule 1 Investing. Today I want to tell you if we're heading for a stock market crash. Okay, so the market's had a few jitters lately, definitely. The overall strength of the current market, I gotta say, has been unprecedented. It's soaring past record after record. It's just off the peak right now, and it's kind of an unbelievable continuing climb up off the disaster of 2009. However, no matter how strong this bull market, the bull market is when it's going up, no matter how strong that is, it eventually is going to come down. No market just goes up forever. And it's my opinion, this is not an advice or a recommendation, it's my opinion for education and entertainment only, that a considerable crash could be on the horizon. And there are a few reasons why I feel the stock market might be heading for tough times in the not so distant future. First, a lot of foreign money is flowing into the US stock market. US investors aren't the only ones who have seen the strength of the US market. Foreign investors are coming out of their weaker, more dangerous currencies, pouring a surplus of money into the US stock market in US dollars. The problem with all this extra money coming into the market is that it leads to really high prices of stocks compared to their true valuation. That eventually will become too high to be backed up by the results in earnings and cash flow of those companies. And then they're going to crash. Second, foreign markets aren't doing that great. Another factor behind the influx of cash into the US stock market is the fact that foreign markets are currently doing poorly, leaving US investors nowhere else to put their money but in the US stock market, and foreign investors nowhere to put their money but in the US stock market. Now, in addition to foreign markets pouring money into the US market, current bond yields are too low to be really attractive to investors, and they may be going the wrong direction. With nowhere else to put their money, US investors are by and large only buying US stocks, which has been the plan of the Federal Reserve all along to drive up the stock market valuations. Now, the problem is at some point you get to unsustainable levels. What's happening with interest rates right now is that interest rates are starting to rise. The Federal Reserve is still manipulating the interest rate market. And as those interest rates rise, bonds are going to get killed. And that continues to shove money into this really expensive market. All right, third, real estate is currently very expensive. You can't even believe what people are paying for real estate in places like Toronto, Vancouver, Seattle. Money is coming over from China that's trying to escape the yuan and become dollars or become Canadian dollars. And they're paying anything they have to. And as a result, those real estate places are selling for 1% cap rates in a market where a 6% cap rate is considered to be expensive. So they are off the chart. Here's the catch. Home prices have rocketed up so fast and have come up above even their high point before the real estate market crashed in 2007 that if they raise interest rates, and they are raising interest rates, it is very likely to crash the real estate market. So the Federal Reserve has itself painted into a corner. They have to raise interest rates to get off zero because it's altering the stock market valuation by shoving up cheap money that they're buying their stocks back with and causing a lot of mergers and acquisitions that shouldn't otherwise happen. But at the same time, if they raise those interest rates, then the mortgage payments become too expensive for any given price of real estate, and bam, real estate prices start to fall. You guys may not remember it, but I do. I sold a house in 1985, and the guy who bought that house went out and got a mortgage. Are you sitting down? He got a mortgage at 14% for 30 years. 14% for 30 years. You don't think that mortgage of 14% had an impact on the price that I could sell that house for? So we have had a 30-year decline in interest rates from that point, and that has benefited the housing market enormously. As interest rates go back to normal levels, it's going to impact the housing prices in a bad way. Next, the Wilshire Index, which is the index of about 4,000 companies. It's supposed to be 5,000. It's called the Wilshire 5000 Index. That index of those 4,000 companies is accepted as a benchmark of the whole stock market. the Wilshire Index, and it is reaching enormously high levels compared to gross domestic product, our GDP. Now, this is a really obvious comparison of market pricing, right? What's the market price compared to the revenue of all of the companies in America? Because these obviously have to be connected. If the revenue goes up of all the companies in America, then the stock market's probably going to go up, right? So GDP and a relationship to all those companies is obviously connected. When the economy is being drastically outpaced by the stock market, that's never a good sign, right? So historically, there's this really interesting place that a couple of points in history where the Wilshire has outpaced GDP. And there's very few times in history when it's as outpaced GDP as much as it currently is. And all of those points are leading toward a stock market crash. In fact, let me just take another second on the Wilshire. Warren Buffett is using this and often is called the Buffett Index. Essentially, what it's looking at is this relationship as we discussed. And today, Buffett has said it gets into trouble when it gets up and above 100%, right? Which is where it's been in 2000, it's where it was in 2007. Today, the relationship is 160% higher. The Wilshire is 160% higher than GDP. We've, as far as I know, never been here before. So this relationship has to change. There's only one way to do it. Well, there's two ways to do it. Either suddenly revenues could start growing like crazy, or the stock market has to come down. That, I'm afraid, is where we're going. So next, index investing. This is what everybody is promoting. Index investing. Index investing is such a low-cost way to diversify your portfolio. And all of these financial advisors are running out there sticking their clients' money into index. It's driving a lot of money in the market. The majority of investors today don't even choose individual companies to invest in. They just stick the money in an index. And I'm talking about your financial advisor isn't even doing that. Just stick it in an index. So they can put it in the S&P 500 index, that's 500 stocks. Okay, boom, instantly 500 stocks. The problem is that index investing pushes the prices up of all of those 500 stocks without any reference to one of them not doing well or one of them doing better. It just drives them up pro rata across the board. And unfortunately, that leads potentially to companies with average performance having incredibly high valuation. And this is a recipe for disaster. Why? Because if index investing is driving this market up, what do you think is going to happen when those indexes start coming down and people say, give me my money back? They have to sell all the stocks in the index, good ones and bad ones, and that market can plummet. In fact, the old saying about the stock market is it goes up like a stair and it comes down like an elevator. Finally, US policy is driving more money into the market, as if the US stock market needed any more factors that cause money to flow into it, right? And drive up its valuations. But current policy is pouring money into the market at an unprecedented rate. The United States is scaling back its balance sheet on the Federal Reserve by $4 trillion and encouraging companies to bring money back into the United States through tax reform. So it's expected that these policies are going to dump an extra $6 trillion into the stock market over time. Now, this is an enormous amount of cash to have flowing into the market, and will almost certainly exacerbate the problem of high valuations. Now, that's a pretty good argument against me that the argument that it's going to crash, because with all this money coming in, nowhere to go, it keeps pushing it. But I can't push it forever. The farther it goes, the bigger the crash. So now I'd like to hear from you guys. Do you think we're heading for a crash? And if we are you doing something to prepare for it? Or are you just sitting there? Leave a comment below with your answer and I'll be sure to follow up with you guys. And thanks for watching. Now go play. If you enjoyed this video and you feel it was valuable for teaching you more about if we're headed for a market crash, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. We got a lot of stuff on there. And don't forget to click the button on the screen for the free gift. It's awesome. And thanks again for watching.